Hello friends. So far, we have covered two methods for valuation of goodwill. First was the average profit method, where we multiplied the average profits of the last few years with the number of years purchased. The number of years purchased is decided based on judgment of the management. Next, we studied the super profit method. In this method, it was assumed that, say, the normal rate of return is 10% and the capital is 1 lakh rupees, then 10,000 the firm would anyways have earned even if did not have a goodwill. The extra profit that the firm earns over and above the normal rate of return is due to the goodwill or reputation of the firm in the market. Therefore, goodwill should be calculated by multiplying the number of years purchased with the super profit. Super profit is the actual average profit minus the normal profit that the firm would have anyways earned. Today, we are going to look at the third method, which is the capitalization method. Under this method, we first calculate the net assets of the company, that is the capital employed, which is the total asset minus the outside liability. Then the average profit or the super profit is capitalized with the help of the normal rate of return. Suppose the net asset or capital employed is 1 lakh rupees. The company firm had earned an average profit of 12,000 rupees. The normal rate of return is, say, 10%. So first we capitalize the average profit 12,000 by 10 into 100. So the average profit into 100 by the normal rate of return, which gives us 1,20,000 rupees. Now, when we capitalize the average profit, this was the actual profit that the firm had earned. So, considering the normal rate of return, your total assets come out or capital employed come out to be 1,20,000 rupees. Like, what is a normal rate of return? That rate is profit is calculated by multiplying the rate with the capital employed. That is what we did in the super profit method. We used to multiply the normal rate of return with the capital of the firm to arrive at what the normal profit the firm would have earned. Over here, we are using the normal rate of return to find out what the capital employed will be if the firm earns the normal rate of profit. So if the firm's capital employed is 1,20,000 and the normal rate of return is 10%, then the normal profit would have been 12,000 rupees. But we see that actually the capital employed is 1 lakh rupees and not 1,20,000 rupees. So, in a way, we have earned more profit than the normal industry average. So, this difference of 20,000 is the goodwill. So, once again, with the average profit, we calculate that the average profit we earned was 12,000 rupees. Had this been the normal rate of return, then the capital employed would have been 1,20,000 rupees. That is 1,20,000 capital employed pay 10% normal rate of return would have fetched us an average profit of 12,000 rupees. But the actual capital employed is 1 lakh only. So this 1,20,000 is actually inclusive of the goodwill. So the goodwill comes out to be 20,000 rupees. Now let us look at a question for this method. So this is a very simple question. It says that the business has earned an average profit of 1 lakh rupees during the last few years. The normal rate of return is 10%. So let us first find out what would be the capital employed if the 1 lakh rupees is a normal profit for the firm. So the capitalized average profit is 1 lakh by 10 into 100, which is 10 lakh rupees. So if the capital employed of the firm is 10 lakh rupees and the market rate of return is 10%, then the firm will earn an average profit of 1 lakh rupees. But it is given that the net asset of the business is 8,20,000 only. That is, the firm has earned an extra profit. So this capitalized average profit is inclusive of a goodwill amount. The goodwill is then calculated as 10 lakh rupees minus 8,20,000, giving us 1,80,000 rupees. So this is the goodwill of the firm. This was a pretty straightforward question. We can have adjustments with respect to the net asset of the company. In this question, you had directly that the net asset is 8,20,000, but there might be that some adjustments are given in the question, so you have to arrive at the correct net asset. The average profit is also given directly as 1 lakh rupees, but it may be that individual profits of the past few years are given and you have to derive at the average profits and so on. We'll do more questions from all these three methods of goodwill valuation in our next videos. So if you have any doubt, you can post them in the comment section as well. If you like the video, do share and subscribe. Thank you.